72 degrees.
You can see Pat sitting there just in a sport coat.
Yeah,
He's
understatement
fine.
of the year. Carry on.
I want to ask you about the framework review, which is something that Mr. Powell is likely to talk about today. What's the most important change that they are likely to make?
If you read the framework review, it was written in a period where we thought interest rates were going to be zero or low forever, right? And inflation was going to be under 2%. And so there was that color to the previous review. That's all going to be taken out, obviously. And I hope I haven't seen the final, right? But I hope that they then emphasize more a balanced approach and more principles as opposed to tactics. Right? We don't need to get into the details of the tactics. That's what the committee does. They need to reassert the principles of the dual mandate.
Well, going forward, under whatever new framework they have, do you think they can eliminate some of the risk that we saw coming into 2020 when Jay Powell here unveiled the last framework, which less than a year later was being junked because of COVID?
Yeah, I get this question a lot. Like, before I went into every meeting, FOMC meeting, did I review the framework and that guided my decisions? The answer was no, right? You face the situation you have in front of you and you deal with the cards you're dealt with. And so the framework provides a broad sense of where the committee needs to go, but day to day, meeting by meeting, it does not drive the decision.
Wait, this is too important. This is breaking news. Do you read the Fed minutes?
Yeah.
Wow, redhead.
I was in there, yeah.
Exactly, of course. He actually listens too. I am wondering, though, what the risk reward here is, and just to sort of crystallize the moment, what the harm would be of cutting by 25 or 50 basis points. And you talked about how you penciled that in. It wouldn't be that big of a deal. Are we just making these big, grand pronouncements about the same thing, that essentially it might make sense to cut on the margins, but not necessarily go wholesale to 1%? I mean, is that essentially what everyone seems to be coalescing around?
I don't see how you would go 1%, right? I mean, that's just simply not in the cards. 25 basis points, what matters is not the number, but the signal it sends, right? Because what the Fed is, because is 25 basis points going to move the 10-year? No, not really. The market's going to move the 10-year. It's more the signal of where the Fed thinks the economy is, right, and where it's going. That's why I like the idea of pausing the balance sheet runoff as a signal. These are signals, not actual, they're not going to be reflected in people's mortgage rates or credit card rates.
Before we let you go, how much are people talking about who's going to come in to replace Fed Chair Jay Powell?
Well, all the time. You guys are talking about it all the time.
I mean, among the Fed members.
Yeah, that I don't know. I mean, I haven't really, part of my deal when you leave the Fed is you have to sort of stay on the sidelines for a while. I mean, obviously people are concerned about that. It's a very important position for this country. And so, yeah, I'm cheering for the team that's making this selection, that they make the right choice.
Patrick Harker, thank you so much for being here. Really appreciate it, and I guess go Eagles. Patrick Harker, former Philadelphia Fed president. We are awaiting that speech from Chair Powell, who is going to be speaking here in Jackson Hole in less than 3 minutes' time. Mike, we have been hearing from a number of people the fear of a 70s type of stagflation light. Not exactly 70s, but that seems to be the emphasis so far in the Fed speak we've heard so far.
Well, it's the data that we're seeing. We're seeing a slowdown in the labor market. We're seeing an increase in inflation. But I think the emphasis at this point would be on the light part of it, because it's nothing like what happened in the 1970s. And this is also very early in the process. We recognize what's going on because of what we went through the last time. So the Fed can react. And in the current framework, and I assume this will stay in the future framework, the Fed will do whatever it needs to do to keep price stability. That's going to be their main focus. And if that's the case, then hopefully they are ahead of any stagflation.
Totally unfair question to you, but I'm going to go with it. With a new framework, whatever it may be, does the Fed become ever more ex post, after the fact, waiting for data?
It's going to depend on how you define it, because what the Fed is going to do is take out the idea that we're going to make policy based on what we think is going to happen. And they're going to say, we're going to look at all the data that comes in. So it could be ex post, or it could be just consensus.
Do the dots stay?
Look, the dots it's all the communication tool. And how do you communicate? Maybe get on Twitter. I will say that we are waiting for Jerome Powell to come out and give his speech. We're less than a minute away. Unclear exactly how he prepped for it. How do you think he prepped?
He had breakfast at the Pioneer Grill.
You saw him?
I said good morning to the chairman this morning, and I did not see if it was, I didn't see if he went healthy or full English.
Oh, yeah.
But,
I can guarantee he didn't go full English ahead of this, but this is going to be a monumental moment for him. His last speech at Jackson Hole as Fed chair with the whole world watching. Does he address independence? Does he deal with...
Okay, if there's one AI site builder you need to meet, it's this dope tech from Wix. Now this whole flow is a
things, and frankly, the international feel here, really notable, as you mentioned.
To me, that's a major theme for me, is the international community is screaming.
Yeah. Micah has some headlines.
The headlines are out. The chairman has started speaking, and here is the key phrase. The shifting balance of risks may warrant adjusting policy. That's going to get Wall Street's attention because it's opening the door to a rate cut. Here's the key sentence. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. The Fed is also announcing its new framework, which is pretty much as we were just talking about with Pat Harker, dropping the reference to the effective lower bound, eliminating the inflation
mic check.
strategy,
Could I get a mic check?
committing to contain inflation
What's up, green fingers?
expectations and concern about labor market shortfalls. But the key here is that there are downside risks to employment. The Fed chairman says the inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising. The S&P 500 now up 1.3%. Yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking
at
these
Bitcoin
as
right now.
Price adjustments.
Look at XRP right now.
So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions.
Let's go.
Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data
I feel like we're seeing dovish reactions in the market so far.
2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that
cautious,
the
not a full green light
from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to
what's going on, Handy Matt? Welcome.
Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker
Powell signaling the Fed will cut rates,
supported by staff analysis at a series of FOMC
Are you dovish or hawkish?
In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic
Get you a drink of water, pal.
Is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008.
Welcome in, guys. Thank you for joining us. Smash the like button.
Painfully slow recovery of that era.
Markets are jumping.
It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted a flexible average inflation target.
What's going on, Ty Stu? Welcome in.
To ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary
XRP
policy
just
would
hit
likely aim
$3.
to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation
that 115K right here,
without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between.
Nice, bro. She might be quitting her job, bro.
With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that
Got safety protocols? Granger has the safety pros to call.
Mandate.
How they gonna do that to us, man?
It also knows that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times
Trump announcement also at noon today
of maximum employment without necessarily creating risks
So-
to price stability. Of course, preemptive action would likely be warranted. if
That
tightness
has
in
to
the
be
labor market
strategically
or other
planned, you know?
factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households,
Nothing
employers,
burgers for
and
everyone.
communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
That was Fed Chair Jerome Powell wrapping up his annual Jackson Hole remarks. What a Jackson Hole speech that was. This is Bloomberg Surveillance on television and radio. Live from Jackson Hole, Wyoming. What we heard there is they are prepared to move rates lower on the heels of their dual mandate being in conflict. We see a market reaction. We could see 10-year yields are lower by 10 basis points. 2-year yields are down by 10 basis points. So 10-year yields are down by 7 basis points. But you see is a weaker dollar, stronger euro by some 0.7%, which you can see the dollar just weakening.
Bitcoin tapped $115,723. XRP tapped $3.
President Trump has been tweeting saying that if Lisa Cook, Fed governor, doesn't resign, he will fire her. There also was some drama.
Bro, 46. Let's go. What is my trades doing right now? Hold on.
Michael McKee is with us.
Look at my
Mike,
trades.
Can you give us a picture of what's been going on as Jay Powell was speaking?
Well, it was shortly before he spoke. Lisa Cook walked.
Bro, you guys remember I've had these trades in for a minute, bro, and I'm up. Bro, I've had these trades in for like. Bro, I've had these trades in for like
to open its
a
meetings
week.
to the public, and the court threw that out. But he was standing there and started shouting at her,
dude,
why did you
and I am
commit
up right now.
mortgage fraud?
I am freaking up right now. Hold on, let me pull it up. You know how good that feels after being down for like a week?
We have to be clear here that
bro,
these are allegations.
I'm rolling right now.
There are no charges.
Let's go. I need to get the chart up so I can move my stop losses up.
Right?
No
bro, I'm slacking today.
And what we've seen from Bill Pulte from the Federal Housing Finance Administration.
I do apologize, guys, because I am late to the party today. I should have been up here and live way before the Jackson Hole meeting ever even happened. I should have been up here live way before it started, but I'm here now, and we're here. Right? So, hold on, let me fix that background. I'm just going to have to turn my fan down on my dang laptop right now. But yeah, let me get logged in here and check on these trades right now, because I might need to be paying attention here. Oh man. Okay. Oh, you know what? Maybe you guys can't even hear that background noise. I don't think you guys can. Okay, we're good. I think we're good.
Market price moves, and now with near certainty for September,
nice,
for the
bro.
Balance of the year, and
let me get logged in here.
Watch the data.
Right. In watching the data in the Heritage Citigroup economics is Willem Bouter, Catherine Mann out the Bank of England and all. There's a complete international and holistic view. Is this ginormous, that's a fancy word, CFA word, folks, this ginormous investment that we're seeing in AI, is the certitudes of this summer, are they at risk given the tumult?
Well, I mean, Tom, you point out something. The market's been really crowded. Most investor segments have been crowded around these secular themes. And for good reason, right? These companies are putting up great numbers. Every company across every industry is investing in AI and technology. So if you had uncertainty around policy or economic growth or geopolitical tensions or international relations or, fractures in the U.S. consumer, everyone was crowded in this space. That said, they're not crowded because these are companies with, they're crowded because these companies have great fundamentals, and the path forward looks great. But what we'll have to see as we go into the back end of the year, if we get okay growth numbers, or
that's
if
crazy,
we get inflation
though.
That's a little bit too perky, if we get rotations in the market.
Let's see, man.
I think some of the rotations in August into the small gap was unwarranted, in my view.
Hey,
so we are sitting here after digesting that
take
speech,
and
I'm going to have to go read it about 3 more times to really internalize all of the complicated messages laid out by Jerome Powell.
Doge, man. Come on, Doge.
Fed chair.
Doge going to keep me alive here. For
Michael
real.
McKee here, our chief economics correspondent. Can you just wrap through some of the key headlines once more so that we can really understand just how big of a policy shift in some ways this really was?
Well, it's a policy shift, but one that has been signaled for a little while, which is why the markets have been buying into it.
Patience,
but Powell
bro.
basically accepted the market's argument that it looks like the labor market is weakening, and that is a threat to the overall economy. And inflation is rising, but it may not rise as quickly as the Fed had feared. And so, therefore, the door is open to a rate cut if we get supportive data from the CPI and the employment report that we get at the beginning of September. Now, the thing about what he said today that I think is important is once you open the door like that as Fed chair, it's almost impossible to close it. It would take a lot in these data points that are coming out to change that view. And the market's going to go overwhelmingly towards the idea of a rate cut. So he's pretty much baked it in at this point. So I think what then happens is it goes to Kate's point about where we go from there. The focus will be on the other two meetings this year and then what you do into 2026.
Baked it in, bro.
The chairman, he would say, we don't know yet.
Right.
That's the data dependent part.
Bro, we got so much support to look at.
You what you think you need.
And right now what you are seeing is almost a certainty priced in for a rate cut next month. But Kate, one other thing you're seeing is weakness in the dollar on the heels of this.
Yeah.
Do you expect that to be very much an ongoing theme, and it just kind of edifies it, given that this is taking the more dovish approach?
Yeah, we had a pause in terms of the weakening of the dollar after a really vicious weakening in the first part of this year. And I've heard a lot of currency strategists say, we're going to tread water for a little bit. We've made a lot of the adjustment. But if the market really believes with high conviction that we're going to continue on a rate cutting cycle, I think it's fair to assume that the dollar would weaken a little bit. I think most people would say over the longer term, they agree that the dollar has been overvalued for a considerable period of time. And I expect that we'll see a little bit more of that adjustment. On balance, though, I think we're going to see appreciation in some U.S. assets, particularly the U.S. equity space, even as the dollar weakens a little bit. And I'm hedging some of the stuff and some of the concerns I have in the portfolio around uncertainty and perhaps pick up in volatility in September into the beginning of October.
If I would have been patient a little bit longer and waited for the Fed meeting,
going to be sticking with City Wealth Chief
I tried to get in on this first little dip right here. Had a chance to take profit.
And get some commentary. Joining us
had a chance to break
even.
Someone
who is very familiar with these types of
but I let it go. And I let it stay in. I let it ride and look.
Recently was in the media talking about his
Bro, Ty Stu, I appreciate you, man.
Rate cuts this year.
Thank you, bro.
Into 2026.
I appreciate that very much.
Also, potential contender, I should say, to be the next Fed chair. Jim,
we're rocking and rolling right now. Doge, man. Doge has been performing so good for me. Doge really just
if you were at that
doing the damn thing.
He used the speech to solidify expectations for 25 basis points in September. I was expecting that anyway. Markets were expecting that. He leaned into the most recent labor market report, which was very soft. And so I think that's a done deal. He didn't say too much about beyond that, what you want to do with the October meeting or the December meeting. I have said 100 basis points, going into 2026. I think you could adjust as you go forward and eventually get a full 100 basis points, but I would go slowly in order to watch the data. And then on the framework review, I'm sure much earlier in the year, they had targeted that.
Green fingers, listen. I came within $100 of my liquidation price. I had my stop loss just like, just barely just to keep it alive,
And they're about.
It feels good right now. It feels good right now. You know what I mean?
So I think they did about.
It really does.
On the framework side.
Let's drop it down here, see what's going on. I almost want to just take it, but at the same time, I want to let it ride because I feel like we had a dovish outlook here.
Term at the St. Louis Fed,
but I would like for us to get up a little higher, and I'd move my stop loss into profit.
Economy decades and decades ago, in the effort to provide for a resurgent St. Louis. Is the next chairman of the Fed, whoever that may be, do they have to manage for two American economies, a technology-driven, exceptional economy, and another, to
definitely
use a
dodged a bullet,
America,
man,
flat on their back? How would a chairman execute those two Americas?
Everything all the way around. Yeah, I think income and wealth distribution have become more salient topics for the Fed. It's not that clear how much the Fed can really do. Providing interest rate policy for the whole economy. If you change the rate structure, that affects everyone, not just one particular group that you might be targeting. So I think that's been something we've had to wrestle with, and I've actually done research on it myself to try to understand it better from my point of view. So I think this has been a theme for a while, and that'll be an important theme in macroeconomics.
Hey, we're bouncing off my entry point now, guys. Look at that.
Mike McKee's got a lot of smarter
That looks
questions than
nice.
me on the immediacy of this speech. I'm going to ask one more distant question, Jim Bullard. You're at Purdue executing online technology education every single day. How do you define the new technology productivity that America faces? Is it enough to save us? Is it enough to really add on to our present GDP?
Oh, yeah, I think that the AI boom is, it's a general purpose technology that will diffuse through the economy. I think the key question is how fast does that actually diffuse? And sometimes markets can get ahead of themselves and think it's going to happen sooner. Sometimes they're too late, and it happens faster than markets think. But nevertheless,
come on.
Any way you look at it, it's an important technology.
Let's go,
it can drive
baby.
Productivity. And I think in higher education is one
Let's
of
go.
the places where you can really have the biggest impact. We put a AI requirement in at the Daniels School here for every single student, and we're trying to expand that to all of Purdue. So I think that just shows you how important this technology is.
Jim, it's Mike McKee. I have
4,600 ETH. Let's go.
In this speech, the chairman is giving his own speech, but basically, when he says it's time to maybe adjust policy, he's speaking for the entire Open Market Committee. Going into a speech like this, would he have polled everybody? Does he think he has the votes for that? Because we've been speaking with Fed officials here in Jackson Hole, and there are still some who are saying, "Well, we're not sure that we need to do that yet."
Yeah, he's going to report on the center of gravity of the committee, even though there might be people that have misgivings. At the June meeting, the committee had a median dot plot of 2 rate reductions by the end of the year, and I think the minutes, suggested something that was more like 50-50. But then the labor market report came in. I think that tilted the balance. So. He could have pushed back a little bit. I think financial markets were expecting him to be a little bit more hawkish here and try to set up a 50-50 meeting where you would wait and see for the rest of the data to come in. But I don't think that's where the center of gravity is on the committee. So he went ahead and leaned in. I thought there was quite a bit of talk about the labor market at the beginning. You could have been a little more, a little more emphasis on the low unemployment rate, for instance. And, he did come out at the end of that discussion saying, well, it's in balance, but we're a little bit nervous. So I think, I think he's accurately
XRP still holding $3. Bitcoin still holding 115,000 and pushing.
Where would you be on this question? Because we've heard Fed officials for some time now saying, yes, we had poor job creation in recent months, but the unemployment rate, as you just mentioned, has been low. And they've described the labor market as solid. Now, this seems to be sort of a major shift in the way they view the outlook and the sort of balance between the two mandates.
Yeah, what he did at the end of that discussion, he said, well, it's in balance. But I think the committee's nervous. I think it has been slowing. And I think the policy rate is moderately restrictive. It's maybe, 125 basis points above the neutral rate.
What is going on, Calabar? I appreciate you dropping that in the chat. Just missed the gain all week. I was bleeding. I was bleeding out too, man. And now we are on the up and up.
Gentle downward pressure on inflation.
We are on the up and up for now. Will it hold?
From Chris Waller and others.
Will it hold is the good question, Let's see. Right? A whole weekend, you know? That's kind of scary, isn't it? A whole weekend. But this did get us back above some serious support levels to look at. I mean, Dogecoin almost at 23 cents. ETH back above 4,500. ETH at 46. Back above 46. If we can hold 45, man, it's looking good. I appreciate you guys showing up today, by the way. Everybody in the chat that did show up, I do appreciate you guys. I was a little bit late. I should have been here a little bit earlier before the meeting, but that's okay. We are here now, and we're going to be covering the market's reaction to Jerome Powell's final speech as Fed chair. And then we also have Trump with a surprise announcement coming up. And we're going to be taking a look at that as well. I am trying to keep my eyes on this too, though. Let's see. Bitcoin going higher here. We just tapped 116. Bitcoin just tapped 116. So did all just before the speech. No. Oh no. Scared money don't make no money. Listen, bro, I was down bad. At one point I was down almost the whole account. I was almost liquidated. I held it out though, and you know what? As of right now, I'm up. Oh man. If you were not already a little bit crazy before getting into crypto, you're going to be crazy now. You're going to go completely insane. You're going to lose your entire mind because it's just part of it. You got to be a special kind of crazy to be in this space, for sure. Come on, ETH, 46, still holding 46. Bro. Come on, ETH. Come on, Doge. Don't get it. Don't get all toppy. Don't get toppy on us yet. I'm looking at this for Doge big time though. I'm looking at this for Doge. I mean, big time. Profit's profit, a win's a win. Hey, you're right. You know, Ragaroth, yes, absolutely. We can take a look at PayPay for you. You're right. A win's a win. Can always get in a new trade. But you can't get back the loss from that trade. You can get it back on another trade. But man, if you secure that loss, it's secured, man. I'm looking at this though, man. I can't help but think. I just can't help but think that this support for Dogecoin's going to hold and that I should leave my trade in. You know? I can't help but think that we're going to be okay here. Now, we do have this secondary support here where we faked out for Dogecoin, and you know, could we come up? Could we get rejected and come back down and test that support around 16? I mean, we could. We could, but I don't know. I like the way this is set up. Measure move target points to $1.25, which kind of aligns with everything I've been looking at for Dogecoin too. $1.25, $1.30. That's what I need. I need Dogecoin to hit $1.20, right? And we'll be all right. ETH still holding 4,600. ETH. This is a wild chart, man. That's a wild chart right there. Okay. All right, let's see. Oh my gosh, let's go, man. Come on. Come on. Come on. Come on, pal. Come on, pal. Pump my bags, pal. Pump my bag. Damn, why does it do that? I swear. I got issues, man. I got issues. I got issues, bro. I don't know what the hell. My microphone keeps glitching out on me. Hey, I'm just grateful and happy that we're live and the live is working, you know? But, yeah. Oh, what just happened there? Come on now. We still got to wait for everyone else to catch up, too. You know what I'm saying? Like, we still got to wait for the rest of the world that's like, you know, everybody that's at work, everybody that's wasn't able to tune in, everybody that hasn't heard Powell's speech yet, right? So that's something to keep in mind. I kind of expect, you know, what do you guys think around noon? Which again, we have Trump with a surprise announcement at noon. So I might just go ahead and see if I can't restart the stream maybe for the Trump announcement. Because it seems like last time I restarted the stream and boom, I don't know what happened, if we tricked something, but green fingers, you know, that's typical, right? Right? Like US pumping the market, we all pumping the market over here, and then Asia just dumping on us. The Asia market open just you know, I'm cautious right now. You know, honestly, with me being in profit right now, it would make sense for me to go ahead and move my stop losses up. But I'm just not far enough above my entry, really, for me to be comfortable with it. But kind of waiting to see what happens right here on this 5-minute candle, man. Look at this thing. Come on now. Oh, man. Okay. Woo. Green fingers, that's what I'm thinking, man. Just to be safe, like I could move my stop loss up here below this short-term point of control right here, right below this previous support that we've found right here. I mean, just to be safe, you know, so I don't have a loss or a risk for a loss. It would be the right thing to do, probably. My only thing is I rode it this long. I rode it out this long, you know. Do I risk it for the biscuit, man? I will say my ETH trade underperformed compared to my Doge trade. Like awful. Like my Dogecoin trade performed phenomenally. Honestly, my Dogecoin trade at one point was erasing the losses from my ETH trade. My ETH trade was down like $200, and my Doge trade was up like 250. So, and then of course we dipped, and I was down on both for about a week, and I held out, man. I held out and waited it out because I wasn't patient enough and didn't wait for the Fed meeting. You know, I got into my trade way before the Fed minutes, the FOMC minutes. I should have waited for the FOMC minutes, right? And see, this is patience comes in, man. And then again, I didn't have patience when I entered my trades, but I did have patience after entering the trades, and that's what saved me, because I could have got scared and closed the positions at a loss, you know. Because, I mean, I got very close to getting liquidated. I mean, I had a stop loss in, but I kept it alive by moving the stop loss because I had a plan, and I had conviction, and I believed that the prices would go up. And that's what's happened. So now the big question is, will it hold, like Green Fingers mentioned, will it hold through the weekend? You know, will it actually survive through this weekend? You know, because if my Doge trade were to go up and hit my take profit, I would make 12 grand off of a very small amount of margin. Very small amount of margin, because I'm 50x. I'm 50x long right now. Now, do I think my Dogecoin trade will run up and hit my take profit before hitting my stop loss? Honestly, what do you guys think? What do you guys think? Do you think Dogecoin is going to continue this run without going down here and hitting going below 20 cents? You think we're good to go? Are we good to run here? Because look at this, man. Don't let this be a fake out. As long as this is not a fake out right here, then my Dogecoin trade is good. Good to go. Good to go. We're above the POC, above previous support levels. I mean, it looks great. Now, resistance up here at 24.5 cents resistance, but looking pretty good right here on that breakout of that downtrend resistance, man. That's beautiful. That's beautiful. What a beautiful breakout right there. If that can hold, man. I can't help but think that it's going to, man. We're gonna have to see what takes place here. Oh, let me see what we're doing here with ETH. We got this previous support here to look at now, on the way back up with ETH. And that's at about 40. We're going to say that's around 48. I mean, 49, right there close to that 5K level for ETH, is going to be that previous support. Previous support here where we broke down. We're going to run up and test that. We're going to try to reclaim that. If we can reclaim that, oh yeah, off to the races. Now, I think it is safe for me to go ahead and move my stop loss on up some. at this point. But I'm still gonna just hold it. I'm gonna chill. I'm just gonna chill here because like I said, these trades have been in for like over a week. This right here on the 5-minute, doesn't look real good, you know. Doesn't look great, but we'll see. Come on now. Guys, don't forget to answer the poll in the chat. Will the Fed cut interest rates in September? So far, everybody thinks that we're going to get interest rate cuts in September. It sounded like we have pretty good odds for interest rate cuts ahead. Now, the market is reacting bullishly to Powell's Jackson Hole speech, but I ain't totally convinced yet. Oh. Something, bro, is not right. Okay, guys, I don't know what's going on, but something ain't right. I am going to go ahead and I'm going to hop off here, and I am going to attempt to be live for Trump's announcement coming up. That'll be in just about, I think, an hour. So we'll see what happens when Trump makes his announcement and how the market reacts to that. But yeah, I will be back, guys. I'm going to keep an eye on my trades here, and I will see you guys soon. Internet connection permitting, willing. I will see you guys soon.